This is Nightly Business Report with Tyler Matheson and Susie Gehring.
The Great Divide. When will the Federal Reserve start hiking interest rates? That question is intensifying the debate and grabbing the attention of investors, Wall Street and Main Street.
Turning point? Target cuts its profit forecast as it tries to win back customers and increase sales. But there may be a glimmer of hope in its latest earnings report.
And subprime trouble? Is a bubble brewing in one of the hottest segments of the economy? We'll have all that and more tonight on Nightly Business Report for this Wednesday, August 20th.
Good evening, everyone, and welcome. Thanks for joining us. The great rate debate intensified today as some of the most powerful people in monetary policy gathered in the small and beautiful town of Jackson Hole, Wyoming. This afternoon, the minutes of the Federal Reserve's last meeting were released in Washington, showing that some officials think the economy is getting better quicker. So much so that the central bank will need to hike rates sooner than planned. The initial reaction in the stock market was one of concern, and stocks shed some of their gains for a short time before they resumed their August ascent. Meantime, a CNBC survey shows Wall Street thinks the next round of interest rate hikes, whenever they begin, will be so gradual and so prolonged they won't end until the next president is in the Oval Office for nearly a year. Steve Leisman is in Jackson Hole, where Federal Reserve Chair Janet Yellen will speak on Friday with a look at why everyone from Wall Street to Main Street will be watching Jackson.
When the leading luminaries of the central banking and economics world converge on the Teton Mountains for their annual conference this year, there'll be three topics on the agenda: jobs, jobs, and jobs. The Jackson Hole meeting, to include the heads of the U.S., European, and Japanese central banks, is set to take a deep dive into labor markets. But it really comes down to a great rate debate between just two numbers: the 6.2% and falling unemployment rate, and the zero Fed funds rate, which hasn't budged in almost 6 years. The key question for the Fed is its easy monetary policy behind the curve of the job market and the economy, risking inflation down the road.
The labor market has largely healed. As you see, employment is back above trend in both services and manufacturing. Today's Fed policy seems not only unnecessary, but fraught with unappreciated risk.
The work of Princeton professor Alan Kruger will loom large at Jackson Hole this year. Kruger, who was invited but couldn't attend, has argued that the labor market is far tighter than the Fed believes, risking inflation. That's because millions of Americans who are long-term unemployed and who have dropped out of the workforce, he believes, are not coming back to work.
It's long-term unemployment which remains high, and in my view, the evidence suggests that the long-term unemployed exert relatively little pressure on the labor market, that many of them, sadly, give up searching for a job and eventually withdraw from the labor force.
Fed Chair Janet Yellen knows of Kruger's work, but has politely dismissed his conclusions.
I think it's premature, frankly, to jump to that conclusion that argument is correct. And I've made some arguments in other remarks that I've given about why I think that the long-term unemployed are likely to move back more actively into the labor force.
Yellen got some backing in the most recent jobs report, which showed 330,000 people came streaming back into the workforce for the third monthly gain in a row. And wage gains were muted. At issue in the great rate debate, when will the Fed start hiking rates, and how far will they go once they start? Judging by years past, when these leaders meet under the Tetons, big things happen. So this year, while it's all about labor, it's really all about interest rates, markets, and the economy. And that's why Wall Street will be listening very closely. For Nightly Business Report in Jackson Hole, Wyoming, I'm Steve Leisman.
With us now to talk more about all of this, Josh Fineman. He's Chief Global Economist at Deutsche Asset and Wealth Management, and Jim Paulsen, Chief Investment Strategist at Wells Capital Management. Jim and Josh, thank you so much for joining us to talk about this very fascinating debate. Josh, let me begin with you. What do investors and business leaders need to hear from Janet Yellen on Friday?
I'm not sure what they need to hear, but I think what they are going to hear, as Steve pointed out, is a big focus on the labor market, that progress is being made, increasing confidence at the Fed that progress can continue, but we're not there yet. that there's still slack. It's too soon to throw in the towel on the long-term unemployed and those who've left the labor force. The Fed would like to give these folks as much of a chance to repair the damage from the Great Recession as possible. So while the Fed, I think, is increasingly getting their heads around the idea that economic conditions will justify them starting rate hikes next year, I think they're going to want to move slowly and cautiously. They don't feel any great sense of urgency, and they'd rather err on the side of, as I said, giving the economy more chance to repair the damage rather than moving prematurely.
Jim Paulsen, today a lot of people, my humble little self included, read the Fed minutes and found them to be maybe a little more so-called hawkish than some people in the market had anticipated them being. Did you read them that way? And if you did, why did the stock market move higher by the end of the day? Is the stock market being naive?
Well, I did read in the same way, Tyler. I thought it was more hawkish commentary than we've seen from the Fed. And I think the market looks at it a couple different ways. I mean, on the one hand, the fact that even the Fed is becoming a little bit more hawkish in their comments suggests that even they are seeing recovery going on in the economy, which really is a good thing. Even they now have confidence in the future of the economy. And I think that's good for the market overall. What the market wants to see is that the Fed also sees improvement, but not to an extent that they have to panically move up the timetable for rate hikes. And that's what I think investors will be looking for in Jackson Hole commentary. Is there a move afoot that we might move that first rate hike up from sometime next summer, maybe up to the first quarter of next year? That would be more concerning for the markets overall.
What do you say about that, Josh? Because in those minutes, it said some members want to move more promptly. Most members were going to be more gradual. What is the risk if the Fed misses the right timetable?
Well, I think there is a more active debate going on within the Fed, and it reflects that we are getting closer. But I think the center of gravity of the committee, Yellen and others around her, are likely to be a little bit slower. They just don't feel that there's this sense of urgency. Inflation is still very subdued. Wages are extremely subdued. They still believe there's slack, and they just feel that it would be imprudent to move too quickly. Now, of course, the economy will be the ultimate arbiter here. If it starts to show signs of overheating, of course the Fed would get going more quickly. But I think the risk of that is still fairly remote. Mm-hmm. And I think more likely the Fed's going to move, that summer timetable maybe, and then just move quite slowly thereafter.
Does it really matter, Jim, whether to the economy and not just to traders in the marketplace, whether the Fed raises interest rates in June of next year or April of next year or August of next year? Does 2 or 3 months really, in the grand scheme of things, matter to anybody but you guys who want to trade?
I think there's truth in that, Tyler. I don't really think that is that critical beyond the trading headlines it creates and the volatility short term. But like Josh said, ultimately it's not the Fed's decision. It's going to be the Fed's bosses' decision, and that's the economy. And I really believe that with the unemployment rate likely to drop into the 5s here very soon and the capacity utilization rate likely to go over 80%, we are just one hot wage number or one hot inflation report away from the economy, the boss of the Fed, telling the Fed and the financial markets, hey, we got to move this thing up. And I think that would be concerning, is not so much when they do it, but if they have to do it more aggressively and quicker in terms of magnitude, that would have to force investors to reprice assets on a different rate schedule.
All right, to be continued. Thank you so much, gentlemen. Josh Fineman of Deutsche Asset and Wealth Management and Jim Paulsen from Wells Capital Management.
Well, despite the small pullback midday on those Fed minutes we've been talking about, the S&P 500 rebounded to within a few points of a new high. But it didn't quite have enough steam to close there. By the end of the day, the index did rise almost 5 points to 1986, its third straight day of gains. The blue chip Dow Industrials up 59 points, and the NASDAQ, however, ended 1 point lower.
Looks like $17 billion is the big number for Bank of America. Reportedly, the bank has agreed to pay a record $17 billion with federal and state officials to pay for its role in the sale of mortgage-backed securities in the run-up to the 2008 financial crisis. The officials say that Bank of America will pay $10 billion in cash and provide consumer relief valued at $7 billion and is expected to announce all of this tomorrow. Also in the spotlight, once again, Bank of America's troublesome acquisition of Countrywide Financial. This is the mortgage lender at the center of the financial crisis. It now appears that Angelo Mozilla, the founder of Countrywide, is on the Justice Department's radar, according to Bloomberg, and the U.S. Attorney's Office in Los Angeles is considering filing civil charges against Mozilla and other Countrywide employees.
Target has slashed its annual profit outlook as it struggles with last year's massive data breach, a disappointing expansion in Canada, and sluggish sales here in the U.S. The nation's third largest retailer reports its second quarter earnings fell 62%. But inside that downbeat report, investors may have found a little gem, a little glimmer of hope. And that could be one of the reasons why Target shares rose by almost 2% today. Courtney Reagan has more.
Another far from bullseye quarter for Target. The big box retailer continues to struggle with falling store traffic and sluggish sales. Plus, its still relatively new entry into Canada continues to disappoint, though shareholders are most disappointed by Target's now much lower full-year profit forecast. Many retailers have been struggling to grow sales and traffic, but Target has additional hurdles. Its entrance into Canada has been nothing short of a mess, and losses there continue to mount. The discounter is dealing with losses associated with the holiday season data breach. And while the breach did hurt Target's shopper confidence, most say, including the company, shoppers have put it behind them. Chief Financial Officer John Mulligan says Target has recovered, quote, the vast majority of shoppers scared away by the data breach. While Wall Street anxiously waited to hear from new Target CEO Brian Cornell on the earnings conference call, he said very little, noting mainly that he's focused on doing his homework, studying up on Target's business and current issues.
Brian did a great job when he was at Sam's Club. I'd expect him to right the ship here at Target. I think the Target's biggest issue is can they really get traffic back into their stores? And it's not really clear to me how they do that without some heavy investment into margins, which obviously means, you know, a lower long-term earning structure.
Target does see signs of traffic improvement over the last 3 quarters and says sales at U.S. stores open at least a year have been positive for the last 6 weeks. Mulligan added the company, quote, feels good about back to school so far. Now investors are waiting to hear the new CEO's plan to grow the business and reinvigorate the brand, though Cornell won't say when he'll be ready to share more. For Nightly Business Report, I'm Courtney Reagan.
Now, American Eagle Outfitters was a bright spot in the retail sector today. The teen apparel retailer reported higher than expected second quarter profit and sales, helped by inventory reductions. The company's interim CEO says the company still isn't performing up to its potential, though. But investors were still happy. The stock finished 12% higher.
One day after Home Depot raised its outlook, rival Lowe's lowered its sales forecast for the full year. The CEO says the company made up most of the sales it lost during the long winter, but it wasn't enough to cover the retailer's full-year sales forecast. Still, the number 2 home improvement retailer did report a 10% rise in second quarter profit and says it's anticipating higher spending on renovations around the house in the second half of the year. That sent shares up 1.5% today.
And Hewlett-Packard reported a surprise revenue gain and a spike in personal computer sales in its earnings report that was released after the market closed. The company earned 89 cents a share. That was right in line with analyst estimates. Revenues came in slightly better than expected at nearly $28 billion, thanks to those strong PC sales, but sales in other units didn't do as well. The stock initially rose in after-hours trading, only to fall back.
Still ahead, is there a bubble brewing in the subprime auto loan industry? Details of a new report next. Hertz is in a world of hurt today. The rental car company says it is withdrawing its full-year forecast and expects 2014 results to be well below its previous estimates because of accounting irregularities and massive recalls from General Motors and Ford. The recalls are hurting Hertz's ability to have cars available for customers. Now, despite all that, or maybe because of it, Carl Icahn has taken a nearly 8.5% stake in the company, according to a regulatory filing calling the stock undervalued. And that lifted shares from a big slump. Still, the stock finished the day lower by almost 4%.
A new report says Americans are having more problems making their monthly car payments, and many of those making late payments or no payments have some of the lowest credit scores. It's the latest sign that the surge in auto sales to people with subprime credit scores could be creating serious problems. Phil LeBeau has more.
Go to any showroom and dealers will tell you business is booming. In fact, new and used auto sales are their strongest in 8 years. One reason why? Dealers are selling more cars and trucks to those with less than ideal credit scores.
Right now, the subprime borrower is, for the most part, staying current on their automotive loans. We're seeing some increases in delinquency, but it's very modest.
Experian Automotive says more subprime borrowers were a month or two late on their payments between April and June. At the same time, the number of auto loans that ended in default with cars being repossessed jumped 70%. While the percentages are still well below where they were during the recession, some are worried the push to sell more cars has lenders writing too many loans to those who can't make monthly payments.
Maybe some of these people should either buy a less expensive car or a used car versus getting a new car and having the transaction prices continue to climb when they maybe can't really afford them.
The average price paid for a new vehicle now tops $31,000. In order to afford that price, with lower monthly payments, more borrowers are stretching out their payments over 6, even 7 years.
The extension of term is a bit of a catch-22. It helps keep those payments a little lower, but at the same time, it does force consumers to stay in that loan a little bit longer.
When auto loans do go bad, the amount lenders have to write off has gone up by almost $1,000. Still, the charge-off amounts are well below where they were at the depths of the recession, when lenders were repossessing more cars than they are right now. Phil LeBeau, Nightly Business Report, Chicago.
A $3 billion semiconductor deal is where we begin tonight's market focus, and that's what Germany's Infineon Technologies is paying for U.S.-based International Rectifier. This is a company that makes chips for satellites, cars, and aircraft. The merger is expected to be completed by early next year, as long as regulators give the okay for the combo. Shares of International Rectifier soared on the news, up 47% to $39.10. A $1 billion forecasting error has cost 2 top executives their jobs at Walgreens. That's according to the Wall Street Journal. The chief financial officer reportedly made a $1 billion forecasting error in the company's Medicare-related business. Shares were off slightly at $62. Profit and sales declined at Staples as the company has faced more competition from online office supply sellers. It's working to close some of its stores and improve its own presence online, but that turnaround won't help the retailer right away. It warned that sales might decline in the current quarter as it sells fewer computers and basic office supplies. Shares fell today 2.5% to $11.32.
Well, with a name like Smucker, it may have to be good, but the results weren't. Disappointing earnings there. The Folgers coffee maker missed on the top and bottom lines, and it lowered its sales outlook. The food company said promotions took a bite, maybe a sip out of its coffee profits. Shares down 1% to 102.42. Madison Square Garden, MSG, not to be confused with the food additive. Mixed quarterly results there. Fourth quarter profit fell as the company was hurt by higher operating expenses. Revenue, though, climbed, beating estimates on growth in its entertainment and sports segments. Good year for the Rangers. Shares popped about 3.5% to $65. Buyout buzz sent shares of Shutterfly flitting higher today. The online photo sharing services provider rose after reports that Silver Lake Partners and Bain Capital are among the firms interested in buying the company. Another report says the private equity firm Hellman & Friedman will make an offer to buy the company this week. That sent the stock 1% higher to $50.47.
And even the Oracle of Omaha can make a mistake. Warren Buffett has agreed to pay a fine of $896,000 to settle government charges that his company, Berkshire Hathaway, failed to report a transaction that boosted its stake in a building products company. In a statement today, Buffett said, quote, "We made a mistake."
Labor Day is almost here, and with it, the official kickoff to the 2014 campaign season. This year, the balance of power is up for grabs in the Senate, and that could have a big impact on the world of business. John Harwood has more from Iowa, which hosts one of a dozen races that will determine whether Republicans or Democrats take control of the Senate.
We found a little news here in Iowa looking at one of the races that will determine the balance of power in the U.S. Senate between Democrats and Republicans next year. It was on the embattled Export-Import Bank. Conservative Republican candidate Joni Ernst came out in favor of the bank, joining Democrat Bruce Braley.
The Export-Import Bank has had enormous positive benefits to Iowa. $220 million in loans, the vast majority of those to small businesses. You look around this state and the ability to export commodities and to export John Deere tractors and combines around the world.
As long as other countries offer that opportunity to their exporters, I think that's something that we need to offer to our industry also.
But mostly this race, like other Senate races across the country, is about big disagreements on economic issues. Obamacare, Republicans want to defund and repeal it. Democrats are defending it. Social Security, Republicans say it may need structural changes to survive in the long term. Democrats say they are going to protect the existing structure of the program. The Environmental Protection Agency, Republicans oppose President Obama's new rules curbing carbon emissions from power plants. Democrats are supporting them in the name of helping climate change. And the minimum wage, Republicans say it should stay where it is at the federal level. Democrats say it should go up to $10.10 an hour. Now, how big are the stakes? Very big if you consider that Senate Republican leader Mitch McConnell today said that if Republicans gain control in 2015 and 2016, they're going to play hardball with President Obama up to the point of threatening a government shutdown. For Nightly Business Report, I'm John Harwood in Des Moines, Iowa.
And coming up on Nightly Business Report, imagine having a green lawn in the middle of drought-ridden California. It's now possible without using any water, and it's big business for some small companies. We turn to California, where the severe drought, by one estimate, could cost the state's economy more than $2 billion. That warning from a new study by experts at the University of California at Davis. To conserve water, some towns and cities have imposed mandatory rationing, but homeowners still want to keep their lawns green, and that's creating a big opportunity for some small businesses. Jane Wells has our story.
Look at this lush green grass here in Los Angeles. How does it stay looking this way? Well, like a lot of things here, it's fake. We're in an epic drought, but one big difference isn't just how bad it is, but how much water agencies are giving away in rebates, as much as $3 a square foot for people to rip out their old lawn and put in something else, like the fake stuff.
3, 2, 1.
Vic Watterson, yes, his name is Watterson, owns Waterless Turf, and business is up 30 to 40%, even though it can cost $10 a square foot to take out the old and put in the new.
I attribute that mostly to the drought, and then also the Department of Water and Power, the water companies providing an incentive rebate to install the turf and replace their live turf with the artificial turf.
Drew McClellan says business has doubled in the last few weeks for his lawn painting business, which costs the average homeowner about $175.
It's kind of sad, you know, it's not good for everybody else, but yeah, for the grass painting business, it's very good. During the summer, you can get up to 3 months. It just depends on, you know, how much it will last that long. I like to refer to it as hair dye. You know, as you dye your hair, you let it grow out. You keep getting haircuts, eventually you're going to cut it off. During the winter, during the dormant season, when the grass isn't growing, you get a good solid 6 months out of it.
One person waiting for his rebate is homeowner Les Bittenson. This is how his lawn looked before. Now he's got a fake one put in by SmartGrass. But even with a $6,000 rebate, it still cost him $19 grand, and he figures it'll take 8 years of water savings to pay off.
Our current cost is about $7.50 a day for water. My projection is we'll be down to $3 a day. That's a considerable savings.
The irony, even with all the new water restrictions in California, in Sacramento, the state capital, it is still against the rules to have fake grass in your front yard. Only in California. For Nightly Business Report, Jane Wells, Los Angeles.
You don't have to mow it either. That's a pretty good deal. Finally tonight, the big business of football. Well, the Buffalo Bills are up for sale. You may want to know how much NFL teams are actually worth in case you want to get a bid together. According to Forbes magazine, the answer is a lot. This year, the average NFL team is valued at just under $1.5 billion. That is up almost 25% from just last year, fueled in part, no doubt, by the $2 billion Microsoft's ex-CEO Steve Ballmer just paid for pro basketball's L.A. Clippers. And everybody knows football teams are worth a lot more. Here's the partial list. Fifth most valuable team, if you can guess, Houston Texans, worth $1.8 billion. Number 4, the New York Giants, valued at more than $2.1 billion. Also worth more than $2 billion, my hometown team, the Washington Redskins, $2.4. They'd be worth even more without that last name. New England Patriots, worth $2.6 billion. And number 1, here they are, 8th year in a row, the Dallas Cowboys, $3.2 billion. First U.S. sports franchise to top $3 billion among globals. The only the soccer team, Real Madrid, is worth more, $3.4 billion. As for the Bills, Forbes puts their price tag at $935 million.
Big numbers.
Those are big numbers.
That's Nightly Business Report for us tonight. I'm Susie Garrett. Thanks for joining us.
And I'm Tyler Mathisen. Have a great evening, everyone. We'll see you back here tomorrow night.
I'm Susie Garrett with a Nightly Business Report news brief. The minutes of the Federal Reserve's last meeting showed some officials think the economy is getting better, quicker, and that interest rates might need to be hiked earlier than planned. Stocks initially dipped on that, but then came back. The Dow rose 59 points, the Nasdaq gave back a point, and the S&P added 5 points. Bank of America has reached a record $17 billion settlement for selling bad mortgage-backed securities prior to the financial crisis. Target slashed its full-year profit outlook as it struggles with last year's massive data breach, a disappointing expansion in Canada, and sluggish sales here in the U.S. And Hewlett-Packard's earnings were in line with estimates, but revenue surprised on strong sales in its PC unit. Be sure to tune into Nightly Business Report right here on your public television station.